Hi and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. We're doing our weekly synopsis of Jeff's Alpha Insights, which is available on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance TV to stay on top of our content. I think we're through 3,000 followers, so thank you for all your support. Jeff, it's been a week of blah. How are you doing?
I'm doing well, Maddie. How are you?
I'm good, thank you. Um, and let's dive right in and kick off with the top down as usual.
Yeah, last week was a holiday shortened week. The S&P was down a little over 1%. We published our, monthly newsletter, which is kind of a big 30-page. I think there were 38 charts in it this month. It's available on Substack at hugeinsights.substack.com. Um, Affectionately entitled "Huge Insights: The Big Picture," and we really went through the bear case in detail. We started out with some big picture ideas. And then we kind of dug right into the economic landscape, which we think points to recession in the back half of the year without a doubt. And with recession, we think earnings revisions to the downside and a significant decline in the S&P 500 before the end of the year. We think looking out, weeks, months ahead, we'll be plumbing new lows on the S&P 500, at least new bear market lows, that is. And with that said, we're trying to kind of come up with some, reasons we could be wrong here, and there aren't many that are really bubbling to the surface. I mean, it looks like everybody's focused on three things: lower headline inflation number. We'll find out tomorrow. I'm not really that concerned about the inflation data. I think it's very much priced in. At the very edge of the margins, maybe we're going to be off a hair from what expectations are, but it's widely expected to be better, right, and lower, and possibly a mid threes handle. And with that, I think the Bulls will have something to get excited about again. The other thing that we continue to hear about is AI, right, and how NVIDIA is going to blow the doors off of expectations when they report their second quarter in August. And, I find that to be a little bit interesting, especially since all the data we're seeing coming out of Taiwan suggests that exports have collapsed by over 20%, and specifically on semiconductors. So, it'll be interesting to see if somehow, NVIDIA pulled a rabbit out of their hat. And the third thing everybody's focused on is that you have seen a better than 24% rally in the S&P 500, and that doesn't happen very often. The one time that we point to in the newsletter is 1929. Off the lows of 29 into the April highs of 1930, the S&P rallied 26%. It then went on to lose 86% of its value before it bottomed in 1932. We think that happened because it was a super cycle degree correction, right? And we count that as super cycle degree wave two. We think we peaked January 2022 at super cycle wave three, and that we're in super cycle wave four down. We're expecting a similar drawn out dramatic decline, something, a la the tech wreck and how it affect NASDAQ, only we think it's going to be a little broader this time. That being said, the NASDAQ did announce that they will do a special rebalance of the NASDAQ 100 index. Accordingly, the top five stocks in that index are now, I think, about 48%. Their rules say that they shouldn't exceed 38.5%. So I don't know exactly how they're going to rebalance it, but they're going to take a lot of weight out of Microsoft and Apple, which are the two heavyweights there. And depending how they count Google, they count it as a company or two separate stocks because there's two separate share classes represented. That could affect how Google's weighted, but all in, I think the Magnificent Seven will likely see something trimmed off the top in terms of their weighting and redistributed throughout the rest of the index. But the reaction we've seen in the stock market to that already appears to maybe have priced it already in. We'll see, right? We're going to find out Friday the 14th what the weightings change actually is. I would expect the subsequent week we'll see some trading around that, and then the actual rebalancing will happen on July 24th. But we continue to be cautious on the market. We think sentiment's really, really reached an ebullient point again with stocks, and that's usually when we're in the neighborhood of a top, and we think we're very, very close. There's the S&P's got some short-term options. We can talk about that, but at the end of the day, we're continuing to recommend our clients remain patient, minimize net equity exposure. That doesn't mean don't trade the market at all, but we're really playing around the edges more, and we like short-term treasuries, 3 to 6 month T-bills yielding 5.5% right now. We think maximize cash reserves to the extent to which your mandate allows you, and get paid to wait and give yourself some optionality. We think things will become clearer over the next 2 to 3 months, and we'll know whether or not this is a true bull market or whether we've reached the top of a bear market rally and we're ready to roll over. That's the view that we're planning on right now.
Thank you for that recap. So, Jeff, diving into your weekly piece, one of the things you're looking at is GDP and GDI and the divergence between them. What are the implications of this?
There's an incongruence between these two data points. And, right now, GDP growth is moving up slightly, so we're seeing slight growth, but GDI growth is contracting. So you've got expanding GDP growth, contracting GDI growth, and that divergence has reached a new record low. And so it actually took out the levels. Prior low was the great financial crisis. And so, the other thing that we can point to is that this same condition existed back in 2001. There was a recession. Between 2007 and 2009, there was a recession. The condition existed then as well. I don't know that we can necessarily draw the conclusion that this guarantees there's going to be a recession, but we can be very clear about the fact that it's not associated with a strong economy, right? And so based on that, I think we have to be cautious here, given the data point itself. By the way, this data comes from Francois Trehan at Trehan Macro. This is not our own work, and not even his own work. It's an observance that he brought out and put on Twitter or some places where I saw it. And so we thought we'd borrow this chart from him.
That's great. And you're bringing up recession. We've also discussed historically, well, over the last several weeks and months, the relationship between an inverted yield curve and recession. This chart in your weekly is actually really interesting. It shows the correlation between length of inversion and length of recession. This is actually really cool. Can you talk us through this?
Again, from Trehan Macro, same report. I believe I got the chart. Now, I think it just kind of speaks to where we've been all along, right? We've been considering all of the leading indicators that point to recession, and probably the most important one is this inversion in the yield curve. It's got an amazing record of foreshadowing recessions. Now, the problem is the timing is not clockwork, right? And that's because changes in monetary policy work with long and sometimes varying lags, right? And so we don't really know exactly when the recession is going to kick off. We've got a pretty good idea, and I could tell you that one of the indicators that we look at suggests that it should have kicked off in the second quarter, and we won't know until the NBER puts their mark on it. But what this particular chart does is it really kind of juxtapositions the duration, right? The duration of the inversion as opposed to the depth of the inversion, because the depth of the inversion doesn't really have a lot of predictive value to it. There's not much you can draw from the depth of the inversion. We've seen, much shallower inversions result in dramatic recessionary conditions like the Great Financial Crisis, right? But it's the length of that inversion. How long has that inversion been in place? And that tends to have a higher correlation to the length of the subsequent recession. So, our point here in the chart is that we're kind of right in the middle of where we saw some relatively shallow recessions on the left-hand side and some monster recessions on the right-hand side. So we're past the shallow recession. We're past the soft landing based on this particular indicator, the inversion of the yield curve. And we're making our way toward a very significant recession as we see the 74, 75, the great financial crisis, the dual recessions in the early 1980s, right? Those are the data points that move a little bit further up and to the right. So I guess at this point, we should be glad that we're not in that quadrant, right? And that we're just somewhere in the middle. But the longer that this condition persists, the more likely we will see a very significant drawn out recession.
So, Jeff, that kind of leads me to the next question. Do you continue, or do you see rates continue to rise?
Well, they are rising, right? So
Yeah.
the forecast is that, when rates break out above a descending trend line, well, that would be indicative of a further push higher, right? And we have not taken out the highs, okay? And once we do take out those highs, that will confirm this condition. But, we saw the entire yield curve effectively bottom around May of this year, right? And we've bounced aggressively off those May lows, which were right around the 200-day moving average. And while fives and tens have both broken out above the descending trend line, neither have taken out their highs just yet. And of course, twos continue to hold below their March highs at this point. And so, given that condition, the one conclusion that we can draw here is that the yield curve is beginning to show some evidence of flattening. Okay, if we were to see twos hold below the March highs and fives and tens continue to push higher and break out above their prior cycle highs, we could very well be looking forward to a flattening of the yield curve. And a flattening of the yield curve precedes a steepening of the yield curve. Now, if we look at the tens 3-month spread, right, that's already seeing a dramatic re-steepening off of its lows to the tune of about 75 basis points. Hasn't turned positive yet, okay? But, I think that this would go a long way toward supporting the conclusion that a recession is on the horizon, because it's usually when the re-steepening is in effect that we start to see the evidence of a recession emerge, okay, and ultimately, be titled as such.
So, Jeff, let's have a look at some technicals here, because obviously we've had not the most volatile week in the last several days. How does the short-term Elliott wave look?
Well, our short-term count on the S&P 500's got some options right now. We know we're very close to the end, right? We've been counting this counter trend advance off the October lows as a double zigzag. We label it WXY. We're approaching a point where wave Y will be equal to the length of wave W. That comes into play at about 45.12. We're below that right now, right? The recent high was 44.58. If we get above that high, I would suggest that there's a cluster of resistance above there at 45.12 to 45.34. That, again, is where those two lengths of trend are equal. That's a common stopping point for a corrective retracement. It's also the 78.6% Fibonacci retracement level at the high end of that range. So, those two do jump out as being kind of a magnet for prices if we do take out the recent highs. Now, the intraday high occurred June 30th. The closing high actually occurred last Monday, the 3rd of July. And so, as long as those levels hold, then I think we should be concerned more about the downside risk, right? That being said, we do also have a very bearish pattern that potentially exists in the S&P 500 on a daily basis, and that is a island reversal pattern. Now, there's a gap that occurs. We gapped up and then we gapped down. And as long as that gap remains unfilled, and we've rallied back into the window, into the gap. We haven't closed the gap entirely. And as long as that gap remains even slightly unfilled, then that pattern remains in play. And that simply is a bearish reversal pattern that would suggest that the top is in and that we should expect the S&P 500 to break down from here. Now, what levels would be significant to us? First of all, the 21-day moving average. If we were to post a daily close below the 21-day moving average, that would give me some significant confidence that the top is in. But it wouldn't be confirmed until we post a weekly close below 43.28 on the S&P. That level marks previous fourth wave low. And once we take that level out, it pretty much confirms that wave Y of counter trend primary wave 2 is terminated. And that means that we are then in the midst of primary wave 3 down, the very early subdivisions. And primary wave 3 down is going to be dramatic, believe me.
So, in your opening statements, you mentioned the super cycle as well. Are there any changes that you see in the super cycle Elliott wave thesis?
No, unless we were to rally, well above that 45.34 level and persist above it, okay? Meaning that, never to return, right? That would suggest that, well, it's possible we've got, some leg of the count wrong and we'll have to revisit it and go back to the drawing board. I don't see that playing out. I mean, there's just too many other factors, both fundamentally, okay, and technically, that suggest that that's not likely to occur. And one of those fundamentals is valuation. I mean, we're in the 10th decile of valuation, right? It's not the beginning of a new bull market when you're in the 10th decile of historic valuations. New bull markets begin when you're in the bottom 3 deciles, right? That's when the best forward 10-year returns are. The work that my team did at the Leuthold group back in my old firm suggests that 10th decile valuations result in the worst forward 10-year annualized returns. And those annualized returns tend to be in around the 3.25% range on average over the next decade. That's well below the 10-year treasury yield right now, which is hovering around 4%. So my suspicion is that we're not in a new bull market just simply based on that. But could we go to a new marginal new high? Yeah, it's possible. It's unlikely, but it's possible. Anything's possible, right? I think what's most likely is we're rolling over right now, and we're going to break down to the primary wave 3. And primary wave 3 will probably carry down into the mid 2000s. We just adjusted our target for primary wave 3 to a new range. That range is actually 2,625 on the high end to 2,375 on the low end. How do we get there? We're using the same Fibonacci extension relationship that we were using before, but coming from a higher level. And so, since the counter trend advance, primary wave 2's carried higher than we expected. We're just basically looking for an extension of 161.8% of wave 1 to the downside, beginning where wave 2 terminated. And if wave 2 terminated on June 30th, then we can come squarely in kind of that 26.25 level for the S&P 500. And that's a big decline. There's a lot of real estate between where we are today and where that comes into play. That will not be the end of it, though, as you know. That'll be the end of primary wave 3. That'll be followed by a fourth wave corrective pattern, probably a lateral consolidation, and then a fifth wave plunge down to our cycle wave A target of S&P 2250. We think that's the area where we're going to get really significant support, and that's where we can expect to make a bet on the long side in that we would expect a drawn out counter trend advance, a wave B advance that could carry for years potentially and retrace over 50% of the decline, which would be a substantial opportunity to recover some of what was lost or profit from the move if you were wise enough to be on the sidelines before the decline. So that's kind of our strategy. Once wave B terminates, we expect cycle wave C to carry to even lower lows. We've thrown out there before levels of 1400 on the S&P, but honestly, Mehdi, that's a guess at this point because we really need to kind of see where wave B tops in order to project where wave C could go. But it could be anywhere between S&P 1000 to S&P 1400, just as a shoot from the hip guess.
Wow, you've done it to me again. I thought 2250 was bad enough, and now you're throwing in 1400 and 1000 as well. So lucky I don't have any hair. Jeff, how are
Yeah,
the journals looking on the S&P?
the internals are terrible. Honestly, we've seen a crash in momentum. For the last several weeks, we've been showing the momentum of the S&P 500 using the RSI oscillator as our primary measure of that. We use a 5-week oscillator. We've been showing it on the unweighted or equal weighted S&P because we thought that, well, it's showing more of a broad element of that. That continues to be negative, but today, this week, we decided to show the cap-weighted S&P again because the cap-weighted S&P peaked, broke back out of overbought area into neutral, made a lower high, and then crashed down to basically negative territory. And so now we've seen, the S&P 500 put in a negative divergence, a negative momentum divergence, which is significant. That tends to precede a major trend change. And so I believe that the S&P is already signaling from a momentum perspective that the cap weighted index is topped and it's rolling over. And that could have something to do with what we're seeing in that rebalancing of the NASDAQ 100 and whatever dynamics will carry out there or have already carried out. But the fact that we've seen such a collapse in a momentum from these overbought extremes suggests to us that the top is in for the S&P. Now, that's not the only thing that's really looking poorly in the internals. It's market breadth. Market breadth continues to look bad. Last week, we saw breadth turn negative, both on a weekly and 5-week basis. The 5-week moving average of the net advancing issues line actually turned negative for the first time in a long time. And so that tells us that, we're not seeing the broadening out in the market that everybody's hoping for. We're seeing a little pop in certain smaller sectors due to sector rotation. We're going to see some of the smaller names in the NASDAQ 100, get some market cap weighting to them. But that isn't likely to be a sustained move, right? It's a one and done. It could happen in a single day through program trading. My suspicion is that we're not seeing the broadening out and it's not going to carry on. And it's also showing up in the volume data. Net advancing volume last week was like 1-to-1, 50% of the volume was up, 50% was down. If we look at the 5-week moving average of up to down volume, that ratio, that's now at like 1.85. As we've talked about before, bull markets, you tend to see that at 5, 6 times, 8, 9 times. When it gets down back below, say 3, it's not impressive. Okay. Normally, you would, in any normal environment, you'd see a 3-to-1 positive volume ratio. So when we're down below 2, that's concerning. And so, across the board, whether it be net advancing issues, momentum, net advancing volume, nothing really looks interesting and positive here.
We're going to dive a little bit deeper into some other indices in a moment. Before we get to that, what about investor sentiment?
Investor sentiment has turned ebullient again on so many measures. We are really challenging the November 2021 peaks in momentum that occurred right around the time both the Russell 2000 topped, the NASDAQ Composite and NASDAQ 100 topped in late November. And within that kind of 2-week range, we saw all of the major investor sentiment surveys peak around then and roll over. Well, we are challenging those levels today again. For example, the AAII bull bear spread is now 22% again. That's exactly where it was back in November of 2021. Not pictured in this chart would be the DSI. The DSI is tradefutures.com's daily sentiment index. They survey retail traders on their positioning and attitudes on the market every single day. And that got up to 75 last week. That exceeded the peak that existed back in November 2021 on the day that the Nasdaq 100 peaked. Okay, so which was 73 back then. So we're above that level. The name exposure index is back to 83%. That's pretty fully invested for this cohort of registered investment advisors and professional investors. But one of the sentiment indicators that I find most compelling right now is insider transactions, right? The insider transaction ratio, again, not pictured in this particular chart, but that's at 33 to 1. There's 33 sales for every new buy by insiders right now. The last time we saw a level even close to that was January of 2022, when the insiders basically reacted to the top in the market and began selling stock. And we're effectively right back there. This is one cohort of investors that you don't want to bet against. They have better information than you do, more of it and more timely. And when they take action, insiders sell for a lot of reasons, but it's clear that one of those reasons isn't because they think the stock is going higher.
Well, 33 to 1 is quite a statistic. So definitely one to keep on your radar. So back to looking at the market cap leadership in the different indices that you examined. Can you run us through why you're not seeing this breadth of the rally?
Yeah, well, first of all, every major segment of the market was negative last week, right? Now, again, it was a holiday shortened week, first week of the month, not really, indicative of predicting the future, right? But, there was some mixed data here. For example, microcap was the best performing, the cleanest shirt in the laundry, I guess, is the way I would look at it. And that was followed by mid caps, right? But the worst performer was the NASDAQ 100 equal weight, okay, which, takes all the weighting off the mega caps, right? And that was only slightly worse than the S&P 600 small cap index, which is the most liquid and most investable small caps that, dominate the Russell 2000's market cap. So, again, the S&P and the NASDAQ were kind of right in the middle. My sense basically is that, we're not seeing the broadening that a lot of people would like to point to right now as being significant. It's at the edges, I guess we could say there's some evidence of broadening out in the market, but it's really not significant at this point.
So before we wrap with some thoughts of Magnificent Seven, are there any sectors of note?
Well, so last week, the only sector that was up was real estate. And that was only up fractionally, right? That was followed by, basically comm services, utilities, which generally are considered to be defensive. So you got three defensives that led last week. That was followed by, I think, discretionary and financials, which are cyclicals, and energy, also cyclicals. But all of those were also negative for the week. And then, we saw industrials and staples and, kind of, the antithesis. One's consumer defensive, one's, industrial, that's highly cyclical, right? All of those outperformed the S&P 500, though. What underperformed was tech and materials, which are very cyclical, but also healthcare, which was the worst performer last week, which is considered to be defensive. Now, I think most of that was because we had negative news from one of the major drug companies, Pfizer. I guess they had a blockbuster drug that, many people had high hopes around that, put that stock under significant pressure. I think the stock was down like 11 or 12% last week. And so that probably contributed, overwhelmingly to the decline or the excess decline in healthcare. But, it's really tough to draw any conclusions from this. I'd say it's basically sector rotation that we've been seeing.
So we have to talk about them. What are your thoughts on the Magnificent Seven?
Yeah, last week, uh, in, I guess broadly speaking, the Magnificent Seven are continuing to outperform the S&P. Last week it was Tesla up 5%, right? The S&P, as you know, was down about 1%. So dramatically outperforming. NVIDIA was positive, Meta was positive. Now, that being said, Apple, Google, Amazon, Microsoft were all negative. I think Apple and Microsoft were the worst performers. They underperformed the S&P 500. But net net, I think there's still a lot of desire to own these AI centric names. You can't open up a newspaper, read a research report, turn on financial news television, and not hear people talking about these stocks in a positive manner and discussing the AI revolution, how it's going to, prove transformative to the U.S. economy, right? That is the attitude among investors right now. And these stocks are the, center of the chessboard with respect to that thesis. What I think is probable is that this rebalancing is going to take some of the air out of that balloon. It'll probably focus on Apple and Microsoft, especially because they are both over 12% of the NASDAQ 100. And so, it's likely we're going to see them trimmed maybe in half or so. The rest of the names, and again, depending how they treat these dual classes of Google stock, they'll probably see a little bit trimmed off the top. But mostly it'll focus on the top five and then be evenly distributed between kind of the bottom 90 stocks, more or less. But, all in said and done, I think these stocks have reached their pinnacle at this point, and it's highly probable that they will start to underperform on a go forward basis.
Well, Jeff, we're going to bring some AI into our show as well. We'll start having two AI bots talking about this stuff. So we'll get on that bandwagon as well. But as always, Jeff, thank you so much for sharing your thoughts from Alpha Insights. It's great having you on.
Always a pleasure.
And to everyone watching, don't forget, go check out Jeff's content on Substack at hugeinsights.substack.com. Until next time, good luck investing.